Investment term of the day, capital asset pricing model. The capital asset pricing model describes the relationship between systematic risk and expected return for assets, particularly stocks. CAPM is widely used throughout finance for pricing risky securities and generating expected returns for assets given the risk of those assets and cost of capital. The goal of the CAPM formula is to evaluate whether a stock is fairly valued when its risk and the time value of money are compared to its expected return. Using the CAPM to build a portfolio is supposed to help an investor manage their risk. If an investor were able to use the CAPM to perfectly optimize a portfolio's return relative to risk, it would exist on a curve called the efficient frontier. This assumes the same things as the CAPM and can only be calculated in theory. If a portfolio existed on the efficient frontier, it would be providing the maximum return for its level of risk. However, it is impossible to know whether a portfolio exists on the efficient frontier or not because future returns cannot be predicted. The expected return of the CAPM formula is used to discount the expected dividends and capital appreciation of the stock over the expected holding period. If the discounted value of those future cash flows is equal to, say, $100, then the CAPM formula indicates the stock is fairly valued relative to risk. There are several assumptions behind the CAPM formula that have been shown not to hold in reality. Modern financial theory rests on two assumptions. Number one, securities markets are very competitive and efficient. That is, relevant information about the companies is quickly and universally distributed and absorbed. Secondly, these markets are dominated by rational, risk-averse investors who seek to maximize satisfaction from returns on their investments. The CAPM also assumes that the risk-free rate will remain constant over the discounting period. Despite these issues, the CAPM formula is still widely used because it is simple and allows for easy comparisons of investment alternatives. In summary, the CAPM uses the principles of modern portfolio theory to determine if a security is fairly valued. It relies on assumptions about investor behaviors, risk and return of distributions, and market fundamentals that don't match reality. However, the underlying concepts of CAPM and the associated efficient frontier can help investors understand the relationship between expected risk and reward as they make better decisions about adding securities to a portfolio. And that was your investment term of the day.